In the past few months, Kenyans have seen the cost of living spiral out of control, with what was about 90 shillings in December last year now costing about 145 shillings, and that's for a basic 2-kilogram bag of maize flour. So imagine how much it has impacted other basic necessities such as school fees or even rent. According to the central bank, about 142.1 billion shillings has been given out to Kenyans as private household loans, signaling tougher times and a growing need for credit. Now, most of this was loaned out at rates averaging between 11% and 19%, but that is about to change. Now, the central bank rate and the treasury bill rate are usually used as a signal to how banks will set their interest rates. Now, with the CBR up to 11%, treasury bills as high as 14%, experts now say this is an automatic signal that banks will have to increase their lending rates on both new and existing loans.
You're looking at the lowest possible rate of 14% on your loans. From that, they'll add on to the bank's operational costs and your credit risk. And so you're likely to see rates coming in at 19%, 20%, and even higher if you have bad credit or you have a bad credit history.
Let's quickly do the math. If you took a loan of 1.2 million shillings payable in 3 years at 15.5% interest rate, you're paying an average of 41,892 shillings per month. But now, if your bank raises rates to 19.5%, your monthly installments will be about 44,291 shillings and 17 cents monthly. That means you'll be paying 28,780 shillings more in 1 year as interest. The types of loans that could be affected includes all non-fixed loans, including mortgages, personal loans and business loans, with real estate borrowing standing at 112.3 billion shillings and manufacturing borrowing approximately 118.5 billion shillings in 2011. Experts say there is a cause for anxiety.
For banks, given that money is their key raw material, then the rise in the cost of their raw material per se will be passed on to the consumer, which is the borrower.
Economists now say they hope that banks will be considerate to their customers and cushion them by minimally raising rates, if indeed they must, or by renegotiating some of their customers' loans. However, it is a catch-22 situation for central bank as it attempts to make the shilling more attractive. The Kenyan credit consumer shoulders the collateral damage. Reporting for Citizen Live at 9, I am Terry Ann Chibet.